Thank you for the invitation to speak at this conference. The first time I actually gave a paper on Minsky's financial instability hypothesis, it was in Paris at the University Paris Sud, the invitation of Bernard Villegas and the circuit group there, and I really have learned a lot from French economists over time, so I'm glad to be presenting at the other end of the financial crisis a model about why it happened and so on. Of course, the starting point for me is always, why did economists not see the crisis coming? Because it was actually, I think in some ways you needed to be trained as an economist not to see it approaching. But there are non-orthodox economists like myself and Anne Pettifor, Michael Hudson and Wynne Godley who did make predictions before it, did say it was going to happen and made public warning. I think Anne's book called The Coming Western World Debt Crisis, written in 2005, probably has to be the best, very definitive statement was going to happen. So it isn't economists in general who missed out. It's a particular group that happens to dominate the profession. That's the majority of neoclassical economists who ignore banks' debt and money and how they model the macroeconomy. And normally I criticise neoclassical economists for that, but if you take a good look in Keynes, you'll find that Keynes also argued that we didn't have to include the actual technical details of banks' debt or money in how we modelled macroeconomics. Now, that's in the preface to the general theory. And in many ways, even though I'll say that it's a fallacy, it's one which is you can find, in as solidly a non-orthodox economist as Keynes can be regarded as being. So the modern models continue this non-monetary trend, which has been part of economics. You can date it right back to Adam Smith and beyond, back as far as John Locke, to argue you should leave money out of your analysis of the economy. Just take it as a measuring stick. Now, this is looking at the modern rationale and why do neoclassicals continue arguing this case. And one of the propositions that put forward is that all debt is a redistribution from one group of borrowers, from one group of lenders to another group of borrowers, and without any major differences in their propensities to consume, this should have no macroeconomic impact. And you'll find the same argument made by Krugman in End This Depression Now, that because one person's asset is another person's liability, therefore we can ignore the role of debt in macroeconomics. Now, yes, okay, that's a truism, that assets equal liability plus equity. Absolute truism. But it doesn't answer the question of what is money. And I think that, again, the best work is done here by European economists, the Graziani in particular from the University of Rome, but the whole circuit theory has a large basis in France as well. And that is the argument that what money has to be seen as an essentially valueless token. Because if you treat it like another commodity, you're just adding one more commodity to your in-commodity model. It's not a genuine monetary system if you say it can be another commodity. It has to be accepted as full payment for goods. Therefore, you can't be using IOUs, which still maintain an obligation between buyer and seller. And it can't confer seigniorage rights on the person or the institution issuing those. And Graziani's logic was to say the only way it can satisfy those three conditions is that payments are made by means of promises to pay the third agent. But that third agent is normally a bank. And therefore, what you're transferring is in return for a full acceptance of a transfer of physical goods or physical service, you will accept a token in the opposite direction, which is the promise to pay of a third party. Now, what that gives you is a triangular vision of trade in a capitalist economy. There's a buyer, a seller, and a bank that records the transaction. And what money, therefore, is the sum of the liabilities of the banking sector to the rest of the economy. So we use those liabilities as the wheel of finance, effectively, and therefore if you expand the asset side of the banking sector and expand the liabilities, keeping assets and liabilities in balance, you expand the amount of money in circulation. And that's the essence of the endogenous money approach of post-Keynesians, which is totally different to the loanable funds vision of the neoclassicals, which is, again, you'll find Krugman being the best exponent of these days because the way he derives the ISLM models by combining a loanable funds model with the physical economy rather than the usual way of having an investment function. So he said when debt is rising, it's not the economy as a whole borrowing more money. It's simply a case of less patient people borrowing from more patient people. And he said the main limitation there is fears about getting repaid. The actual level of debt is irrelevant to the macroeconomy. Now, I've just recently worked out that I can contrast these two visions in a very simple manner using the software package I've been developing for some time now with the help of a grant from INET, and then also recently with money from the Kickstarter campaign. I'm trying to get my pen out of this computer here, okay, which I call Minsky in honour of Hyman Minsky, and I call the accounting side of this model a Godley table in honour of Wynne Godley, who developed the idea of tabular displays of financial flows. That's a very large bank icon. They were working on reducing the scale of that in future versions of the software. Pan in so you can see the rest of the model here. And pardon the graphics, they're dreadful right now because we're still working on the graphics, but you can see I've got the debt to GDP ratio. I'm going to show that in a moment. GDP and debt over here. The amount of money in the patient and inpatient person's accounts, the amount of money in the banker's accounts. Given those graphics looking as bad as they do, I might bring up the, if I can bring it up here. I'd remember put the microphone down for a second. Bring up some larger windows which I can show while I run the simulation here. And I'll just now bring up the Godley table, as I call it, which lets me show the relationships in the financial sector. So I use this to build system dynamics models, which are normally, does anybody here know what a system dynamic model is? Good. One person. That's the sort of response I normally get in economics, unfortunately. I think we should really learn a lot from engineers. They use flowcharts to build dynamic models, and I find it almost impossible to model financial transactions using a flowchart because of the requirement to put one transaction on two system states at all times, with signs being in the correct direction. So this is a tabular way of laying out financial transactions. Let me say lending is from one agent to another, so there's always two entries at least, and they always sum to zero on a row to make sure I've got the accounting correct. And what I've got here is lending from patient person to inpatient. Can you see the text there? Okay. And then interest payments from the inpatient person back to the patient, and repayment by the inpatient person back to the patient person. And if I simulate this model, then you'll see the rising debt ratio, and the flat line there is GDP. Nothing happens to GDP because I've got both patient and inpatient being capitalists who've hired workers in their firms, have much the same production technology, and therefore, if there's a change in the amount of money being turned over by patient, the patient lends more money out, inpatient's got more money to spend, the level of turnover is exactly the same, GDP is unaffected. And I'm sorry about the graphics being hard to demonstrate here, but if I change the level of the rate of lending, so I have a much lower rate of lending here, notice the GDP ratio, which is the green line, plunges. If I accelerate that dramatically, I can get the level of debt easily exceeding GDP, particularly if I change also the repayment rate. These are, again, the graphics have been rescaled out of sight a bit here, but I'll try to bring them back in by moving some of these icons around while the simulation runs. We're always pushing my luck with the software. Okay. You can see a drastic rise in the debt to GDP ratio there as the repayment slows down, and then as repayments accelerate, it drops again. But GDP simply flatlines. Nothing happens. And that's the vision that neoclassical economists have of the financial system. And if they're right, then the level of debt is completely irrelevant to macroeconomics. Okay? But what I can do, and I'll just jump onto the next slide here to bring that up in a moment, is what I've shown you there, and this is to make the table a bit clearer to read. Again, the lending from patient to inpatient, etc., and all the wage and other transactions down in the bottom part of the table. And what I can do to simply say, well, let's look at the loanable, the endogenous money vision that post-Keynesians have. That's to simply say, well, lending isn't between patient and inpatient agents on the liability side of the banking sector. Lending actually belongs over here. The bank creates a loan, and that creates a deposit at the same time. And then, of course, interest payments is at the bank. So I've got a column I call safe, which is basically where the bank's cash flow flows to, where they can make their profits from. And repayment, of course, is back to the bank. So all I've got to do is shuffle those pieces around and then change the initial conditions as well. And I can do that. I'm going to try doing it live, which is always dangerous. Lending's over here, repayments over there, and I can't unfortunately, it's like just click over here a bit. Here we go. Interest payments are over there. Now I know I go back to that model and stop it, and I'll try to put these objects in the better position for me to be able. Oops, I'm drawing a wire there, which I don't want to do. I flip over to being endogenous money. I'm just trying to move a few of these icons around. I should have tested this on the screen before I started the simulation. Now if I run this model, have I set it up properly? No, pardon me, still one more thing to do. And that's I've got to change the initial conditions as well. So there's actually some money. The loan here is being created by a loan rather than by a payment. I could break that into half loan and half reserves, but I'll leave it that way just for the sake of the illustration. Now if I run the model, notice instantly I've got something very different happening. GDP is growing. Okay? The growing money supply is part of a growing economy. If I change the rate of repayment, then I have a drastic impact on the level of GDP. If people repay more rapidly, or loans are handed out at a slower, that's actually reducing the rate of lending there, which slows down the economy. That's increasing the rate of lending. This is now increasing the length of time it takes to repay, so there's more money in circulation. Then if people get worried and repay more rapidly, and lending drops off as well. So I think it's a fairly simple illustration that if you have an endogenous money vision of how the economy operates, lending is vital. Lending is an essential part, and the ratio of debt to GDP is a major issue in the economy. And that's all it is. That simple shift between those two visions gives you that result. So that's a better look at the graphs for loanable funds. Change the debt ratio, nothing happens to GDP. The jump and the fall I've got here is when I change the rate of turnover of money in the firm sector. Okay? The debt's irrelevant. But when you take a look at the endogenous money vision, where you say the bank that do the lending, banks to non-bank, that's the sort of impact you get. So it's a mental block that neoclassicals have to imagine that money lending is with loanable funds, which leads to them not understanding the role of debt in the capitalist economy. Now, when you take a look at that role properly, you've got to end up redefining a larger part of macroeconomics as well. And I'm going to go through a bit of a definition here, which gets me accused of double counting, but I'll show why that's not towards the end here. So let's define income. If you measure GDP using the income approach, you'll say you can break it down into wages or profits. And you can divide profits into the profits that the firm retains and profits that it distributes. And look at expenditure then and say, well, you're going to expend the money either on consumer goods or capital goods. I'm leaving out asset markets and government, but I can bring that in, which I do in other analysis. So there's expenditure measured as consumption and investment. Now, when you have two sources of demand for this and you admit that money is endogenous, so the borrowing that consumers do expands the money supply, it doesn't involve the equal offsetting of loanable funds vision, then consumption by workers will be equal to wages plus the change in workers' debt. And ditto for capitalists, and both of these terms can be positive or negative. Okay? Unlike the income term, which is always positive. Well, not for capitalists, they can get negative profits, but that possibility is there for negative and positive changes. The negative you'd see as being savings, ditto for capitalists. And then looking at investment, there's two sources of a demand for investment goods, either retained earnings or new debt. And by the way, there's a very good empirical set of papers by Fama in French establishing this relationship. Quite bizarre. You'll find when they do good empirical work, often neoclassical economists come up with conclusions that contradict the doctrines but are empirically accurate. So borrowing for firms can be negative as well. They can disinvest. Now, let's put those two equations together. There's expenditure, consumption plus investment. If I expand out what consumption and investment are, that's the whole set of terms I've now got. And if I rearrange that, so I can now subtract income from expenditure, I get a few cancellations. And what I conclude is expenditure minus income is equal to the change in debt. Okay? Expenditure and income are not equal. Expenditure is income plus the change in debt. Well, that's what's left out of conventional macroeconomics, including the definition that Keynes gave, which still dominate a lot of post-Keynesian economics. Now, it sounds like double counting to most people, and this is one reason that I haven't been able to get it through to a lot of my post-Keynesian colleagues who learn neoclassical. But that's not entirely the case. So people like Michael Hudson always understood this proposition. Dirk Bessemer is on board with me. Richard Werner's work is very similar. So there are certainly people in the post-Keynesian community who accept this now, but a lot of them still think that there's got to be double counting going on here, because one person's income is another person's expenditure and so on. Well, the reason that happens is what we're doing, and not even aware of it, is actually becoming accountants when now we should be economists, and that we're doing measurement ex post and saying when you measure income and measure expenditure, you will find them being identical. That is a quirk of accounting applied to the data, the flow of data after it's been. Economics should be looking at what causes those changes through time. So if you look at Keynes, you'll find that the way that Keynes discusses ex ante versus ex post in 1937, I think an alternative theory is the rate of interest, actually realizes this as well. Let's imagine expenditure on a day, a single day. You've got 24 hours there. And it's running at the level of $1 billion per day. And then somebody borrows, point D in the day, $100 million and spends it into circulation. Of course, you've got much, much smaller chunks than that. I'm just whacking it all at one point in one day. Then from that point on, expenditure is going to run at $1.1 billion per day. That is your income ex ante at time D. That is a change in debt also at time D. And that's expenditure at time D. There's a jump between the two. And when you measure it, that's going to be recorded income because once that money is spent, it becomes somebody else's income. So the accounting point of view will be actually like integrating the area beneath that curve over a period of time. So if I want to find the income over a 6-hour period, I then integrate across that 6-hour period. And if I happen to catch the point where the debt injection is in the middle, I'll find a recorded level of income and expenditure of $262.5 million. But if I recorded an earlier period, I'd find a recorded income of $250 million for the same time period. And then after it, I'd find the $275 million amount. Okay? So the fact that we record it is because integration applies the jump to both functions. But if the jump hadn't been there, the income would have been lower for the day. The expenditure would have been lower. So that's the important point, is that expenditure is income before a debt injection plus the debt injection. And because of endogenous money, the debt injection doesn't cancel out. So you get an expansion in income coming out of it. And the discontinuity here is the reason why we've missed it in our thinking. So when you say that their recorded income is equal to recorded expenditure, you're actually stating a mathematical property of integration and also accounting, but you're not stating economics. The economics are looking at the changes. So I'm giving a very I've been criticised for using a long line here to explain, to give a time to this, but I think what Volra was trying to do is to get that accounting identity element into a non-monetary model of capitalism, which was the wrong place to put it. We need that accounting identity in a monetary model of capitalism, and the people who tried to do that were Schumpeter and Minsky, and they could both see the same issue I've taken you through now. They both are quite happy with the idea that expenditure is income plus the change in debt. You read Minsky's work, particularly his early work back in '63, and you read also Schumpeter, Theory of Economic Development, you'll find this being said virtually as explicitly as I've said it there. Now that also means you have to redefine aggregate supply, but not just goods and services, it's also net turnover on the asset markets. So we're looking at what turnover of the asset markets is. You can again break that down and say it's going to be, roughly speaking, the price level of assets multiplied by the quantity, multiplied by the proportion that turn over in any particular time period. Now that gives you very strong implications for macroeconomics and finance. For a start, change of debt is going to be a factor in the level of employment and level of output. And when you look at the rate of change of the aggregate demand, you get an acceleration term. Acceleration in debt will have an impact, of course it's going to be spread through all the terms on the other side of the equation, an impact on the rate of change of asset prices. Now to show how strong this empirical data is, let's just take a look at some of the data in the last 20, well actually we're going back 50, 60 years, but I'm also looking here at one fundamental point of it. When you get a bubble in asset prices, it must burst because it's driven by acceleration of debt. To have a sustained bubble in asset prices, you require sustained acceleration of debt, which you can't have. At some stage, they have to break. And there's a very good work now being done by Morris Schulleritz and Taylor and a few others, funded by INET, establishing that if you look back over a 150-year period in about 15 OECD nations, you find that the crises are always preceded by acceleration of debt, and the greater the acceleration, the greater the crisis afterwards. We're just going through the worst one ever recorded. So let's look at the empirical data here. Starting here from the American GDP, the level of public debt, which is the blue line, and the level of private debt, which is the red line. Now, just even looking at the data, that's enough to make most people wake up, I find. Where American politicians are obsessing about the blue line approaching the dotted black line, which is GDP, ignoring the level of private debt, okay, which is 3 times higher. Now what I want to do is take that and look at the change in debt, because I'm arguing GDP is income, expenditure is income plus the change in debt. So the black line here again is GDP, but the red and blue lines are now the change in those 2 types of debt. And the dotted line indicates when the recession began according to the NBER. And notice that it almost perfectly coincides with the rate of growth of debt dropping from $4 trillion a year to minus $3 trillion over a 2-year period. That's why the crisis hit. We simply had a change from, because demand is income plus change in debt, we went from a debt-boosted economy to a debt-inhibited economy when that rate of growth of private debt slowed down. Notice, by the way, that the level of growth of public debt is minuscule compared to that of private debt. Again, the focus that theory gives us on worrying about the public sector is misplaced. And notice how we had 2 years of heavy deleveraging here, and then a recovery where you can just see at the end of the chart there. I've got a later version of the chart taking us into 2013. I must update this chart. You finally got to the stage where the private sector is borrowing money once more, and therefore adding to aggregate demand. Now, what I do now is the black line is GDP once more. Notice how the downturn in nominal GDP occurred well after the start of the crisis. But the red line is GDP plus the change in private debt, and the blue line is GDP plus the change in both private and public debt. And what I'm now arguing is that in the private sector terms, America went from an $18.5 trillion economy to an $11.5 trillion economy in just over 2 years, which is a hell of a crash. That's why it was such a severe downturn. And the public sector spending attenuated it. It went from being roughly a $19 trillion to roughly a $13 trillion economy. Still a huge hit, mainly hit taken by the asset markets, but also, of course, obviously by employment and GDP. But that's why we had such a huge crisis. Now, I want to show the correlations here. And I've got a causal argument. I often get this correlation as in causation, but I'm starting from a causal argument. So let's just look at what the relations are. Again, neoclassical theory would say explicitly that there should be no relationship except during a period of zero interest rates, where the so-called zero lower bound affects the capacity to reach equilibrium in the money market. So I should be finding a zero correlation here between change in private debt and the level of unemployment. I'm not a great statistician. I'd rather have somebody else analyse the significance there, but I've got a feeling minus 0.71 is significantly different from zero. Okay. So with rising debt, you get falling unemployment, and the opposite correlation applies with public debt. And this, let's just put the public debt rise in recent times into context. When I look at a shorter time period, because the level of debt has risen, the private debt level has risen substantially from 1970 to 1990, the correlation actually rises dramatically. So if I look from 1990 to now, I get a correlation between the rate of change of private debt and the level of unemployment of minus 0.92. And I get a positive correlation of plus 0.83 between unemployment and change in public debt. So looking here, the blue line is the change in the private debt. You can see that drastic drop off there and bounce back. The red line is unemployment, which is almost like a Rorschach plot opposite. That's how strong the correlation is. But public sector debt follows unemployment. So what the public sector is doing is reacting to the slowdown in the private sector through its automatic stabilisers, fundamentally, lower tax returns and higher welfare payments. That's why the public sector debt changes. Now, I argued about the relationship between level of debt the change in debt and the level of employment, of course, that implies a second differential argument between the acceleration of debt and the change in employment. And that was something I actually didn't empirically investigate myself because I simply didn't think the data would support it. And then a group of economists, Biggs, Meyer, and Peck, did that instead, what they call the credit impulse, and they found the relationship. So I went and took a look at the data as well. And this is looking now over 20 years, through two or three booms and busts across that time period, on the correlation between acceleration of debt and change in employment is minus 0.74. Again, a stunningly high correlation for a rough second order effect, because I've got to approximate acceleration, of course, given how volatile the data is, between that and unemployment change. The same thing applies for asset markets. Where did the asset price house bubble come from, and why are the American mortgage market recovering now? Entirely because of the acceleration of debt. When you look at mortgage debt, acceleration of mortgage debt, and compare that to the change in real house prices in America, notice I'm looking over from 1955 to virtually 2015, 6 decades of data. Booms and bumps, house prices being stable right up to about 1980 compared to consumer prices, then the huge bubble and so on. The correlation is 0.78. It's ridiculous to get correlations like that, particularly when people tell me they should be zero. So we need a macroeconomics for endogenous money. And that I see as fundamentally Minsky's financial instability hypothesis. And that is a model completely independent of neoclassical theory. It starts from historical time, two things which are completely missing from neoclassical economics. If it's historical time, you remember a recent recession. So let's go back to the 1990 crisis in America. And because of that crisis, both firms and banks are conservative about debt-financed investment. So they only put forward conservatively estimated projects, but because the economy has recovered, most of those projects succeed. And because of that success, firms and banks think, if we'd borrowed more money, we would have made a bigger profit. So the accepted ratio of debt to equity starts to rise. You start to put a high valuation on assets. And Minsky's classic phrase, stability is destabilizing. A period of tranquil growth causes rising expectations. Very, very different to the so-called rational expectations of neoclassical economics. Now, for a while, this is a positive thing because with a decline in risk aversion, you have more investment, and that causes the economy to grow faster, which validates that investment. But you also get rising expectations leading to what Minsky calls the euphoric economy. And that's where people are basically behaving not only like they're on cocaine, because if you know some traders, they actually are on cocaine. Totally euphoric expectations about the future, everything's going to be rosy and wonderful. And you get an expansion of the money supply as well as I've shown, which enables riskier investments which are losing money. A lot of these investments are futile. They're losing money. The only way you can continue operating is to paper them over. So you have a large group of people in the system who are fundamentally bankrupt, and only being kept alive by rolling over debt in an atmosphere where people don't ask difficult questions about your cash flow. They're what Minsky calls Ponzi financiers, who have a cash flow that's less than their debt servicing costs, and they only get out of trouble by selling assets in a rising market. They're completely dependent upon that rising market, and they desperately demand money, so they'll drive up the interest rate in response. And ultimately, you get rising debt levels and potentially also rising market rates lead to a crisis because some conservatively estimated projects are now hit with a higher discount rate than they expected and are therefore speculative in Minsky's terms. Some non-Ponzi investors will sell assets into what they think is a broad market. And you also have a debt deceleration effect. As that starts to happen, the asset price bubble ends, and it's basically goodnight Ponzi's. They're the very first ones to go bankrupt normally because they can't sell assets for a profit and they can't roll over their debts anymore either. Asset prices collapse, the expansion of the money supply goes into reverse, and you're back where you started from, which would now say be about the 2000 crash. But that's the vision that Minsky has. And the process will repeat itself when debt levels fall, but there's a tendency for that to start from a higher level of debt to GDP. And then you can potentially get a crisis where the level of debt in the aggregate can overwhelm the servicing capacity of the economy, which is where we got to in 2007. Now, I've built models of Minsky's theory, and again, for an economic audience, I need to explain why I do some very different things to neoclassical theory. So it's monetary, strictly monetary model. I first of all built a model just with debt and implicit money in that sense, now built models with explicit money in them using the Minsky framework I've shown you a moment ago. I built it on a dynamic and cyclical model. I don't take stability for granted, nor do I linearize around a non-linear system. There's no micro foundations, and there's very good neoclassical reasons for doing this, because if you read the Sonnenschein Mantel Bordeaux literature, you find that they show that you cannot derive a market demand curve, let alone an aggregate demand curve, that has the property of an individual one. There's a very important statement there. It's been very badly put in most of the literature, but they show that every polynomial, any squiggly line that doesn't intersect itself and doesn't return two y values for 1x, can be a market demand curve. There's absolutely no capacity to aggregate for an individual to get a collective demand curve, as is believed in neoclassical theory. And the best response to this was done by Alan Kerman, where he said, if you take this seriously, fundamentally, we have to work at the level of social classes. Okay? It's taking us back to the classical school and saying the classical way of modelling was correct. Micro foundations prove you can't have micro foundations unless you're working at the level of social classes. I also use a linear production technology, and SRAFA is the best argument as to why that is theoretically sensible, but it's also been empirically confirmed by about 150 academic papers, the last of which was by, of all people, Alan Blinder, which said when you do empirical research and ask them what are their cost structures, they find that at best 11% of GDP is produced under conditions of rising marginal cost. The whole idea of diminishing marginal productivity is empirically not supported. And I don't use a Cobb-Douglas production function for a similar reason, because as well as embodying diminishing marginal productivity, that also, when you analyse it, it is simply a linear mapping of income equals wages plus profits under conditions of fairly constant income shares. That's all it is. Like, it's a fantastic R-squared because you're correlating one with one. And if you bring an energy, then you can make it valid, as Bob Ayres is doing these days, but you no longer get a marginal productivity theory of income distribution coming out of it, because you've got to allow for the contribution energy makes. Now, I start from using Minsky, Richard Goodwin's cyclical model of the economy, which he wrote back in 1967, and that's putting it in the flowchart form that system dynamics people use. You can start by saying there's a rough relationship between capital and output. So working with a simple constant relationship here, I can say capital divided by an accelerator relationship will be the level of output. Then there'll be a similar rough relationship between output and the amount of labour you hire, given labour productivity. That will then determine the employment rate, given population. And that determines the rate of change of wages via the Phillips curve argument, which, despite all the discussions in economics, every last economic model has. Integrate that and multiply it by the wage level of employment, and you get the wage bill. Subtract that from output, you get profit. And in the simple model that Goodwin put together, all profits are invested. So if you integrate the profits, you get back to the level of capital stock. And that closes the model. It's a classic system dynamic where it goes back to the beginning again. Now, when you simulate that model, you get cycles. You don't get equilibrium. Quite a common result in genuine dynamic sciences, which economics had better grow up and learn about. So I modeled that in Minsky, and I'll see if I can bring that model up now. In fact, it's probably better to run a simulation, run a movie of it, because it actually runs a bit slowly. If I run this as a movie, what you'll now see is a rising debt ratio over time. That ratcheting up effect that Minsky talked about verbally actually turns up as a characteristic of the model. But if you're looking at just employment and inflation, what you see is a great moderation. Everything's wonderful. Thank God for great monetary policy. Wage share is declining over time, but to paraphrase neoclassical economics, it gives a flying rat's ass about workers anyway. There's no concern about income distribution in neoclassical theory. What you're not noticing is a rising debt ratio. Your profit ratio, which was stable, suddenly clashes, employment falls, and you're into Great Depression, which is what the syndrome we've been through now. Now, the model doesn't include the capacity for writing off debts through bankruptcy, which is an essential part of getting out of a crisis like this. And I haven't included in this particular model the government spending back into the system, which attenuates the whole thing. And I get runaway deflation because I have workers accepting money wage cuts, which end up being real wage cuts when you have falling prices. But that's the dynamics that you can get out of the system as I've put it together. Now, it has two equilibria. One where you want to end up, which is positive wages share, positive employment, and finite debt. But it's also got a bad one, where you don't want to end up, which has got zero wages share, zero employment, and infinite debt. And you saw in that simulation that's where that particular model was headed. Now, both those equilibria are locally stable for quite a wide range of parameter values, but the good one narrows with rising debt and rising interest rates. So you don't want that to happen. You don't want to get, you want to get close to the good equilibrium, and you don't want to get anywhere near the bad one. But the trouble is getting into the bad one, into its sphere of influence, is a bit like passing through the event horizon of a black hole. You don't know you've done it until you try to get out of it. Then you realise you can't. So what we need to do is destabilise this bad equilibrium. And Minsky argued that big government spending could do that by stopping the collapse in profits that normally occurs in a downturn. So I just want to show that that's actually what's happened. You look at the empirical data between this crisis and the 1930s. What I'm measuring here is the rate of change, the contribution that private debt finance makes to aggregate demand as a percentage of GDP, starting from the point at which it made the biggest contribution before the crisis itself. And in the 1930s, that was in 1928. This is using annual data here, so it's a bit rough. But annual data showed that the change in private debt in 1928 was roughly 8% of GDP. So you got an 8% boost at this stage. Then by 1930, it was zero. And from 1931 to 33, the private sector was reducing its debt at a rate of 25% of GDP per annum. That's why the Great Depression was so deep and prolonged. Notice it came out of it, started to borrow money again about 35, and went back into another slump of deleveraging between 36, 37 and 39. Now what I'm going to put over the top of that is the government spending. So the next line includes the change in government debt as well as private debt. And what you find is that there are a couple of periods where there was almost about an 8% boost to aggregate demand. The biggest was what we now call the New Deal. Okay? Deliberate policy by Roosevelt. But notice there's also a period where this gap narrows, which means that government's trying to get back to surplus again. And this was when Roosevelt got worried about running a permanent government deficits and bankrupting the nation. So you had what we now call the Roosevelt recession at that stage. And we only really got out of the Great Depression courtesy of the government spending during the Second World War. It wasn't over. The process wasn't over during the Great Depression itself. Now, I want to now compare that period to where we are at the moment. So this next chart shows, next line, shows the percentage of private sector spending, which is debt finance, from its peak in our crisis, which was 2008. And that gives you an idea of why the crisis was so much more, really, well, it did feel more severe than the Great Depression, and it was. We fell down to much the same rate of deleveraging of 25% of GDP, but we began from private debt finance being equivalent to 22% of GDP. That was a huge fall, bigger than the Great Depression. Why did it last such a short time, or why are we back in re-leveraging already? Largely because of what the public sector did. The public sector added an additional 3% to demand back in 2008, courtesy of all the ridiculous spending the government was doing for wars in Iraq and stuff like that. But when the automatic stabilisers kicked in and when Obama's stimulus hit, that was the scale of the stimulus package the government gave back in the other direction. And that encouraged the private sector to stop deleveraging. And therefore, we got back to leveraging again, as you can see here, where including the government spending, the debt finance contributions up to about 10% of GDP, which is quite, not high by historic standards, but in the range of what it should be in a normally growing economy, slightly above that scale. So my worry is that if Americans go back to austerity, they could end up being like Europe for all the wrong reasons. They don't need to do it. They don't have any treaty forcing them into it, but they could cause a relapse if they do that. Now, with Minsky's thesis, when I include the government spending in there, and I'll bring this one up and run it at the same time if I can. No, I haven't got it live, unfortunately. When I do that, notice that I get cycles in employment. This particular graph here is employment versus wages share. And rather than breakdown, I get cycles around a good equilibrium. That's what we should be trying to achieve. Let's see. No, wrong one. I can't run that. That's the previous simulation. So in summary, Keynes was right and also wrong. A monetary economy is fundamentally different to barter, and you must incorporate banks, debt and money to do macroeconomics properly. Leaving that out of the general theory, I can understand why it wasn't done. It's a technical challenge to do it. But that was a mistake, which let us reinstitute the previous barter model of the economy. And the reason I've written Minsky or designed Minsky is that it's easy to do that with this software. So what I've shown you up on screen is a couple of times ago is quite easy to drive. It's got lots of bugs right now. The more development money I get, the better, because I've got to pay a program $100 an hour to work on this software for me. But this is quite easy to build monetary models. Now, looking at the actual crisis we've been through, both the boom beforehand and our current crisis were caused by a private debt bubble. And if we're going to end the crisis, we have to reduce private debt, not public debt. The first priority is getting private debt down. And in fact, government debt money creation is actually a stabilising force, but it might not be enough given the scale of debt run-up we've allowed to happen. So we need to model this as well to understand it. A large part of why we have the crisis is because we don't understand the system we're in. At the same time, we have an economic theory, neoclassical economics, predicated on the belief that people understand the future because they have a perfect model of the economy. Hilariously ridiculous, but that's the nature of economic thinking, leaving banks, debt and money out. Now we have to get to the stage where we understand the process system properly. Some of the realism I saw in earlier sessions here is what we need as being part of economics in future. Now, I don't think we're going to get there in a practical sense. Humanity's capacity not to learn until after a crisis is phenomenal. So I want to give you an idea of how long we could take if we continue the rate of deleveraging that this crisis began at. I'm now showing you the ratio of private debt to GDP and public debt to GDP. You can see, of course, that public debt is far smaller than private debt. But if we actually continue this deleveraging rate, and by the way, America is now re-leveraging to some extent, it could take us out to 2030 before we're back to the debt levels that applied back in the 1960s. Now, I know Japan can survive something like that, but I don't think America or Europe can. I'll leave it at that. Thank you.